Hello and welcome to the Can I Retire Now podcast with your hosts, Nick Russell and Becky Wagoner. I'm your podcast producer, RJ Malik. We've got Nick and Becky joining us. The episode today, it's episode 5, Financial Literacy, Empire Strikes Back. I'm intrigued by this. Becky?
Yes. And the empire in this case is our wonderful government, and specifically the tax man who always finds a way. So, Nick has some exciting stuff to talk about with retirement and taxes today.
Yeah,
so.
let's be honest. Taxes aren't like the sexiest thing in the world, but every investment you're ever going to have, homes, stocks, whatever, are going to be taxed in some way. Mm-hmm. So I figured it'd help with a little bit of a visual. So for those that are listening, just the audio, we're going to go through a couple of slides. They'll be available on the website under the episode. And for those watching on YouTube, hopefully this kind of softens what otherwise can be a really kind of bleh topic to talk about. All right. So first thing I always like to talk about when we talk about taxes with investing is something called the tax triangle.
So this is exciting. Geometry and taxes. Move over, peanut butter and chocolate. We've got a new duo in town. Okay. All right.
Yeah, I know. This is right up my alley, right?
Yeah.
So
sorry. This is as exciting as going to the dentist and DMV in the same day. All right, let's do it.
All right, let's do some learning. Buckle. I know. A lot of support I get at home.
I'm sorry. It's
fair though. It's fair. This is not the most interesting thing, but it is so important that we want to make sure to talk about it. So, the tax triangle. We use a triangle because there's 3 different types of ways you get taxed with your investments. Let's start with what we call tax-deferred. Tax-deferred simply means that you're not paying taxes each year. It is deferred until you take money out of the account. So accounts that would qualify in this instance would be things like your 401k or 403b at work, any IRAs you have, and also annuities. These aren't things you get taxed on from year to year. But when you retire and you take money out, that money is going to get taxed 100% of it as taxable income when you're retired. The next category is taxable. So these would be both individual or joint investment accounts. Sometimes they're called non-qualified. Qualified is a term that our industry kind of cooked up to discuss, kind of qualify retirement accounts. So non-qualified becomes these more liquid non-IRAs, but also your real estate and honestly just even checking and savings, CDs, money market funds. Those are all considered taxable accounts.
Every year?
Every year. So when we earn interest on our money market funds, we get a 1099 tax form at the end of the year that says, oh, you earned $20 in interest. And here comes the empire. They're going to want their share. That's taxable income.
Okay.
After tax, really the 3 kind of investment vehicles that fall in this category are Roth IRAs, 529s, and some investment grade life insurance. So Roth IRAs are really for retirement. 529s are for college education planning. And investment grade life insurance is really kind of a hybrid of a life insurance product that also has an investment aspect to it. But the one thing they all have in common is that when you take money out of the accounts, it's 100% tax-free.
And that's because you paid taxes before you invested.
Correct. And that's why we call them after tax. So think of this as you wrote a check from your bank account. Well, your money's already been taxed via payroll taxes because you earned that money and you pay taxes on it then. Now when you put it in, it's after tax. So that money gets to grow. It is tax deferred while it grows, just like an IRA or 401k. But the major difference is it'll be 100% tax free. So tax deferred means taxed later. Taxable is something that's taxed every year. And then your after tax money will be 100% tax free. That make sense?
So if it's 100% tax-free, why wouldn't you just invest like in your Roth IRA if you could have one or whatever? Like if that's a better, is that a better question? I don't understand. I mean, yeah.
Yeah. So conceptually, it's a great idea. Now, Roth IRAs specifically have income limits. So if you make too much money, you cannot contribute to a Roth IRA. Also, there's maximums you can save. So this year, the maximum is $7,000 a year. So, it's not like you could put $10,000 or $15,000, or it's like 401ks, you could put up to $25,000. So you can't save as much there. But for those that qualify and could put the money in a Roth, absolutely, I find them to be extremely valuable products. The other trade-off is, what do we think tax rates will be in the future? If you think tax rates will be the same or higher, then Roth IRAs, having that money that's tax-free, yeah, it's really attractive.
Okay.
All right, let me give you an example, though, that kind of really walks through kind of the impact of that. So here we have something called the tax time bomb. This is something I learned 20 years ago, my first year in the business. And I think it's probably the best example of why you might want to do one or both or whatever the case may be. So the example here is we're going to use a client or a person that makes $50,000 a year and has a 401k available at work. So they turn around and say, you know what? I'm going to save 10% of my money in my 401k. So that's equivalent to $5,000. Now, in current tax rates, we're assuming 22%. Just by putting the $5,000 away, they're going to save $1,100 in taxes. Because
so they don't have to pay taxes on that then?
Not on the money they put in, because they're putting in what we call pre-tax. So before their taxes get calculated, they get to deduct that $5,000. So they're not getting taxed on $50,000, they're getting taxed on $45,000. And that difference is an $1,100 difference in today's tax brackets. So that only doesn't happen once. That happens every time you contribute.
Okay.
So year one, you put $5,000 away, you save $1,100. Year two, you put $5,000 away, you save $1,100. You do that for 20 years, that's $22,000 in taxes that you didn't wind up paying. Or if you get a refund, you get a bigger refund than you expected.
Okay.
Just by putting money away in your 401k, which, by the way, which is why 401ks are so great. You put the money in there, maybe your company gives you a match, but you're also saving money on income taxes just by saving money in your retirement account.
Okay. So that's appealing, right? Because you're paying less income taxes every year and you kind of have more money in your pocket and in your savings in a way.
Yeah. I think this is why, you're 22 years old, fresh out of college, you start your 401k at work, let alone maybe there's a match and all the growth. It's wonderful.
Okay.
Now let's talk about the other side. We're going to assume in the future, we're still at the same tax rates, which I think with the amount of wars and country debt and just stuff, personally, I think tax rates will probably be higher in the future. But let's say they're exactly... Yeah, I know.
So exciting. Way to be optimistic.
Well, okay. I just want to be realistic. Right?
No. I mean, it's important, but all right. So
let's say it's the same.
It's flat. Okay.
Right? And when clients come to me and they say, Nick, I'm ready to retire, I say, great, how much money do you want? Now, of course, we plan for all this, but traditionally people want to live the same kind of lifestyle they lived while they were working.
Makes
so
sense.
if they made $50,000 a year, they're going to want $50,000 a year. So that means, assume we grew their money to, all the way in infinite amounts, we have to take $50,000 out of their account. But now with the 401k, because it's tax deferred, you pointed it out, we get taxed on that now. So assuming a 22% tax rate, you're not actually going to get $50,000. You're only going to get $39,000 after taxes.
Well, because this does not feel like a good deal.
Well,
okay.
Yeah. I mean, it's fair. You got to save all that money while you were saving, and now you have to pay the tax man.
Fair in a government kind of fair. Okay.
Yeah.
Got it.
Well, at 22% on $50,000, that's $11,000 that you paid in taxes. So imagine you take $50,000 out of your account, only $39,000 hits your bank account. So problem one, you're not living the same lifestyle you did while you were working, which was your hope. And number two, you can see by this slide, after 2 years of that, $11,000 coming out each year to pay taxes, you've paid the same exact $22,000 in taxes after 2 years that it took you 20 years to save through contributions.
This math doesn't work very positively.
It doesn't work for you? No.
I mean,
and look, yeah, tax rates could be lower in the future, and this could be better for you, but it's never going to be.
You just told me there's
trade-off.
Wars and climates and everything. I don't know. Okay, but yeah. All right.
So how do we fix this? Right? Because you don't like this. You don't seem happy with this.
Is there a better way?
Well, what if instead of putting all of our money in a 401k, we put some in the 401k and some in a Roth? Now, I will tell you, we talked about Roth IRAs and that there's income restrictions, limits how much you can put in. A lot of company 401ks now have Roth options. So it wouldn't matter what you made, and the limits to those Roth contributions are the same as 401ks. So important to be aware if your company offers that. No matter what you make, you could do this. But let's take that same person that makes $50,000 and now wants to live on $50,000. So let's say we saved them both, we grew it, same as before. But now with no expertise, they just say, I'm going to take half out of my 401k, half out of the Roth. Right? Keep it super simple.
To get your $50,000 annual income.
Correct.
Okay.
So the $25,000, the half of it that comes out of your 401k, we already know will be taxed. Now, I'm assuming the same tax rate of 22%.
Yeah.
It's $5,500. The $25,000 you take out, you will pocket $19,500. Now, this may actually be better because if your $25,000 is taxable income, it may actually keep you in a lower tax bracket.
I was going to say, do you get taxed on all your, just what you withdraw from the taxable accounts?
Correct. The taxable and the tax-deferred. So this tax rate may actually be wrong. It may be 12%, and this number would look even better. But let's stay conservatively on the taxman's advantage. Yeah. Well, what happens when we take the money out of the Roth is we talked about it's 100% tax-free. So you get the entire $25,000 that you take out of that account. You put those two together, it's $44,500 a year, which, from the previous example, is way better than $39,000.
Yeah.
So this example just shows that if you save the same amount of money, you invest in the same things, earn the same rate of return, but just allocate where the money was put. Again, from an account standpoint, not even an investment standpoint, you split the money up. Now you're netting more money every year with the same amount saved, same rates of return. Now, we talked about if tax rates are higher in the future, this number is going to look even dramatically better. But I think this is something that everybody should at least be aware exists and understand how it works. Okay.
I have a question about the taxed every year. Like is there an annually taxed retirement plan, or are we just talking about, I guess real estate's considered an investment plan, like people sell real estate when they want to retire? Is that what the annually taxed one? Because that doesn't sound like a good deal.
No. So the annually taxed one would be any kind of investment account somebody has that's not an IRA or 401k. So think of like an account at Charles Schwab or at, a TD Ameritrade, which is now Schwab, Robinhood account, any investment account in that respect, where you can put money in and take money out every year. Major advantage there is it's liquid. You could put money in, take money out.
You can pull it out
before retirement age.
It's affected. Okay.
Yeah. So, and you're right about real estate. If we sell an investment property, we're going to pay capital gains on the money we made on that investment property. And in fact, an investment property that we rent, we have to pay taxes on the rental income minus the expenses every year.
And we pay taxes on the property every year,
And you pay property taxes, and we pay payroll taxes, and we pay sales taxes.
They find every dollar, don't they?
The empire does strike back, right?
Gosh.
I'm telling you.
All right. Okay. So, well, this makes sense. And those are the three different types. So I guess it is important to have different kinds of investments.
It does.
You're right. Okay. Man. All right. Well, thanks for sharing that, Nick. Now we know what the tax triangle is.
So, Becky, now that we reviewed that, what do you want to go over today?
Thrilling piece of
I know.
information. The tax
For anybody who
triangle.
hasn't fallen asleep yet, what else is in store for them?
Well, while we talked about tax rates, I went down and did some historical tax rates. And while we all might be a little bummed about paying taxes at all, much less the rates we pay today, did you know that the highest tax rate in the U.S. history was between 1944 and 1963, and it was 94% for the highest income earners? Why would you even make money at that point? 94% tax rate? Yeah. So the bracket on that, though, was for those in 1944 making over $200,000 a year. The average income for that year was like around $2,500. So, I mean, it wasn't definitely not affecting very many people during World War II even. But they didn't knock it down again until 1963. And in fact, there was a tax rate at 70% until the 80s. And in the 80s, it was 50%. And it wasn't until after the 80s that we now have the current tax rate that we do for the highest one being around 37%. So 37% is less than 94%. So I think we should all be happy at this rate.
And it's I think this is something that we're seeing now with interest rates, where people, it's like kind of a perspective thing. Like, if we're of an age where we didn't pay income taxes at a 50% rate, at a 70% rate, at a 90% rate. So it's very easy for us to see, oh, wow, the top tax rate's 37%. That's crazy. But historically speaking, tax rates are basically the lowest they've ever been right now. And interest rates are the same thing. People are like, oh, I don't want to get a mortgage at 7% because I just had a mortgage 3 years ago at 2.5 or 3. But 7 is historically average. But that perspective kind of really gets skewed. Yeah, I know. I'll save that for our episode on debt and real estate and stuff. Ooh. But I know. Oh, we're covering all the hot topics. Yeah, I know.
Okay.
Wow. But yeah, that's wild when you think about it.
94%.
How high tax rates are.
I mean, I don't know who. Anyway, that feels like a lot.
It is a lot.
So, all right. So, exciting talk about taxes today and retirement. Do we have any homework to give anybody, Nick? So,
I know. For anybody who actually made it through all of this, congrats to you.
Well done.
It was a challenge. I know.
Touch and go for a minute.
I think I saw Becky yawn while I was talking about the tax triangle, but thanks. So I think a reasonable follow-up for people, an easy one, is really just take a financial inventory, right? Look at the types of accounts or where you have money. Checking, savings, money markets, investment accounts, retirement accounts, and just see where they fall in that triangle, and where then you're contributing money. So you might have categories in all three pieces, but maybe you're only contributing to a tax-deferred account. Well, that gives you an idea of, well, if I'm saving for another 10 or 15 years before I retire, where you're likely to be overweighted. I didn't share this earlier, but right now, about 90% of all people that have investable assets have 90% or more of them in tax-deferred only.
They're in for a surprise.
Which, hey, that's where your 401k is, right? So it's the easiest one to contribute to. It's the one you contribute to the longest. It's tax-deferred. It's naturally that it grows over time. Roth IRAs weren't even a thing a couple decades ago. But yeah, it becomes a challenge then, especially with what you shared about tax rates. And if they're likely to be higher in the future, it winds up being a real disappointing conversation with your financial advisor later when they say, hey, here's your $50,000. Just kidding. Here's 30, here's 35. So we want to aim
for a more equilateral triangle.
Wow, look at you throwing out high school geometry. Man.
It's a good thing our daughter just took this and I had a refresher.
Yeah.
Helping her with her homework.
So. Things I never thought I would hear you say. Equilateral triangle. I love it.
Yeah. Mm-hmm. There we go.
Excellent. Well, I think that's good for today. I I think that's if anybody has any follow-up questions or wants to view these slides, the slides will be, again, available on the website under the podcast section. If you have any questions or help trying to figure out where your stuff falls, we have like a little chat box on the website. Feel free to send a message. It goes right to me and my team. Happy to follow up, answer any questions we can.
And your website?
Oh, website would be helpful so you know where to go, is sunrisewealthadvisors.com.
Very good. Thanks, Nick and Becky. And we're looking forward to your next podcast. And thank you for listening to today's Can I Retire Now podcast. Please like, follow, and share this podcast with friends and family. Until next time, for Nick and Rebecca, I'm R.J. Malik.